Oh, hello, everyone. This is Aaron Philbeck here at Kai Association, Managing Director of Content and Community Strategy. I'm joined by Yingwen Chen, who is a partner at Allborn Partners, and we're going to be talking about the future of the industry and where we're all headed here in capital markets. So Yingwen, thanks so much, and welcome to the World Rewired.
Well, thank you, Aaron. Hi, everyone. I'm Yingwen, based in Hong Kong. So I look after the Pan-Asia private equity and venture capital fund coverage for Allborn as well as everything Greater China. At the same time, I'm also the deputy chair for the Greater China Exco at Kaya. Okay.
Great. Well, Yingwen, as you very well know, we've been on this global listening tour here at Kaya, hitting the road and having these closed door conversations with senior leaders, allocators of capital, leaders of organizations. I think both to help us with our organizational strategy and where Kaya's headed as an organization, but also I think helping us as we position our education, our thought leadership, how we think about talent acquisition and so on in the broader capital markets spectrum as well. So these have been really fruitful discussions around 8 different centers of capital. You were a part of one of those conversations. So what I thought we would do is pull you from the secret room that we had with these leaders and dive a little bit deeper into some of the insights that we have from this forthcoming paper that we're publishing that serves as kind of the culmination of all those different conversations. And I wanted to start with maybe the biggest question and the macro question that we're focused on in this paper, but also just as an association, which is this, I think this growing sentiment from leadership that we're in a bit of a regime change. This is more than just a shift in market cycle. The world is being rewired, as we've said. So maybe if you just take a step back and look at regime change as a theme, does that resonate with you? How does it resonate with you? And then how do you kind of think about what that looks like in practice with the clients you work with
Mhm.
at Allborn?
Yeah, well, I think first just setting the backdrop, right? Coming from Asia, regime change actually happens probably a bit more frequently than you think. I used to cover Latin America as well when I was investing in hedge funds. Same thing, right? Like, the presidents change and policies change pretty dramatically. Kind of administration to administration. So I would say I think in this case, I'm not sure I want to use kind of wholesale rewiring, but certainly there is some sort of paradigm shift. There is I think there were risks that you didn't have to consider before that you now have to consider. For example, we took globalization for granted, right? We just assumed that everyone was going to work very nicely with each other, and globalization was the big theme. I think today, it's very clear there are factions, right? There are factions, there are new alliances being made. So how does that translate into how clients think about stuff? I think, first of all, at the top level, it's still relatively stable because no one, at least in the world of private equity and venture investing, we don't think about investing like, what happens when the president changes in 4 years, right? The fund terms are like 10 years. So the first step for me really is, what is my investment policy statement, right? What sort of returns am I going for? What sort of risks am I comfortable taking? And then we look at the current environment, right? So with all these that's happening, what does that mean for my expected return on a forward-looking basis? How does that increase the risk profile? Where the risk profile has increased, which it has, across the board, then how do I think in terms of, are there mitigants that I could use? Or if not, then how much more risk premium do I need, for the risk I'm taking with my capital? Or I might have a target return. Is it time to kind of rethink those targets? Right. In the world of private markets, I think at one point, especially covering China, I think 2 years ago, it was so depressed, right? Like everyone we spoke to, no one wanted to talk about China. The world was convinced, China was going to go to bits. There were no exits. Capital was stuck. Fundraising was stuck. It just felt like that was the ultimate gloom scenario. But fast forward, you had DeepSeek moment last year, and then today, in the last, I would say in the last quarter, all of a sudden things have changed, right? So China is now exciting. Hong Kong was the top IPO market in 2025. We're talking about LPs getting like surprise Christmas gifts from realizations from funds that they had actually even forgotten about, right? So I think it really is more about in terms of kind of forward looking, unlike previous years where you could assume some level of stability for a longer period of time. I think what investors have to work with now is, what are all these unknowns? What are the curveballs that could hit me? I mean, same time, same similar time last year, when Liberation Day happened. I can still remember we happened to have a roundtable of some of our biggest LPs, who are some of the biggest allocators in the world, and they were saying like maybe we need to reduce U.S. exposure, right? And maybe we need to allocate more to Europe. And now fast forward kind of 8 9 months, it's like guess what? Well, U.S. still has the deepest financial market in the world, right? That you could have policy risk, you could have administration risk, but the financial markets are the deepest. It is the most sophisticated. So a lot of I think what we've observed is a lot of the capital that went out looking for ex-US exposure have actually started to come back to the US just because they're looking around the options and kind of portfolio construction, and fundamentally a number of these GPs are genuinely doing a good job. Then it's like, oh, do I should I be scared of by these sort of headlines?
Yeah, there's a lot there that I want to respond to. Maybe going back to one of your early responses to me, which is, private markets, we're not reacting to a 4-year cycle, or in some cases that you just highlighted, a 18-month cycle.
Mm,
Tariffs can come and go or whatever. So on one hand, there's kind of the reactive nature, which is where a lot of the public market investors, let's tactically invest in a market and pull back. On the other hand, you've got private markets, which you kind of have to invest through a lot of this stuff, which means that your underwriting and your assumptions around rates and inflation and geopolitical climate, the US role versus Europe and parts of Asia, like you've got to have a view that takes a much longer term horizon. So I'd be curious, maybe with that mental model of investing through some of this transformation, has that changed, or how has that impacted how you might underwrite a manager, or you might underwrite an investment thesis or an opportunity differently than maybe 5 10 years ago when we were all taking globalization for granted?
mm. Yeah, I would say I think one of the biggest takeaways, and not just in the last 18 months, but in fact through COVID, increasingly the operational value add um, coming from the PE managers, especially, right, has really come to the forefront in terms of something that we really prioritize in terms of our diligence. Um, Especially as you mentioned, rising interest rates, right? So I think in the early days, margin expansion or multiple expansion, as well as financial leverage, financial engineering, that could drive your mid-teens returns very comfortably, right? So you didn't really need to any post investment value add or operational value add was a nice bonus. It was like cherry on the top. Um, I think in the last few years, especially through COVID, where leverage is getting more expensive. We've seen companies kind of going under on the weight of the amount of leverage or debt that was put on them. Increasingly, right, that post investment ops team is a key asset for many of the GPs, especially when we look out here in Asia. I think there are two things, right? One is it's not a very large pool of that sort of talent, right? So it's all concentrated in kind of some of your big brand names. But then when you look at all these single country funds like China again, as an example, which was one of the hardest hit, right? How do you help your companies navigate through these sort of markets, these sort of scenarios? And consequently, I mean, today we're also looking at founders of businesses. It They're no longer just simply looking for capital. I think they also learned their lesson. They're looking for partners who can help them in some way or form. Right. In some cases, it could be we've seen anything from a company founder saying, look, I have this one shareholder that I really want to get rid of. right? Could you please help me, GP, please come in, help me buy them out, and then so that I can then move on with the strategy that I really want to run. In some cases, it could be, look, I think I'm leader in my country or in my region, but I really want to expand. I think I've hit a ceiling, and I'm not quite sure what to do next. I really want to expand, right? So these are things that is beyond just coming in and saying, hey, I can give you a valuation that is 20 times or 50% above the market, or more than the next guy that just offered you. I think founders today are also, it's been a bit of an education process, right? So previously, founders hadn't really worked with private equity, or they hadn't seen how people could work with private equity, and then now they have. Um, Conversely, I think when we look at venture, I think one of the biggest questions we got, I think 2 years ago, we were kind of pounding the table a little bit on China kind of healthcare venture, and then in the last kind of 12, 18 months, we were talking about China venture like slightly before DeepSeek happened. Um, and one of the biggest questions we were getting really was kind of all around, well, why, isn't there, wouldn't a black swan event happen that would just render all Chinese investments kind of zero? Um, and, the policy risk was real. One common question we got was, oh, isn't China going to just keep my money? Like, will they let me take my money out? I mean, the truth is, we've not seen that happen with at least the GPs that we work with, right? And some of these have funds dating all the way back to like 2009, 2010. We've not seen capital being captive, right? Like not being allowed to take out, even if it's an A share listing. But I think that the risks and the perception was very, very real at that point in time.
Yeah. So if I can editorialize a little bit, as I'm hearing you speak, a lot of this is bottom up opportunities. So the macro is important, maybe from a positioning at a portfolio level, but I guess what I'm hearing you say is despite all of the noise and policy and changes and rates and all those kind of things, the fact that these are long-term investments, venture is a decade-long, opportunity. It's much more kind of let's get back to basics and
Mm,
focus on what's the investment thesis of the underlying portfolio companies. And yes, there's going to be these kind of short-term disruptions and shifts, but it's kind of playing on the good old-fashioned bottom-up selection, even though all the noise around us is happening. Is
mhm.
that a fair summary of kind of what you just walked through?
Yeah, yeah, yeah. I would say I think it comes back to markets do move in cycles. It's just how long that the bottom of that cycle kind of drags out, and typically, right, the more U-shaped it looks, the scarier it seems, right?
Yeah, yeah. So you've talked a lot about China. One of the things that we've highlighted in this paper, and I think just generally in our travels, is this idea of new centers of capital popping
Mm,
up. As you mentioned, the U.S. is still a force, and it's got the deepest financial markets in the world. But China is an area where there's been a lot of interest, a lot of innovation. The DeepSeek moment. You almost have this parallel economy that's occurring
mhm.
next to the U.S. We've talked about the Middle East and the role of the Middle East has played in capital markets. Where do you kind of see, maybe outside of China, which I think you've hit really well, but where do you see kind of those new centers of capital popping up, and what are kind of the implications that you see if you're looking in your crystal ball that reshapes the way our industry functions
Mm.
as they continue to pop up?
Well, so from as a funding source, right? From a perspective of kind of a GP raising capital, the Middle East undisputed, right? Is the new market that pretty much all GPs around the world have been rushing into to raise capital from, and they are very eager to back, right? Innovation. They are also very eager for capital that is going to reinvest back into the Middle East. I think the Middle Eastern, especially the sovereigns or sovereigns related, they do have strategic goals, right? About around IT, around data centers, around kind of improving their own ecosystems. So we're seeing kind of capital that comes with certain level of conditions from that pool. I think especially the sovereigns. Out in Asia, we are also increasingly seeing various Asian sovereign funds coming up with programs that that are very similar to what the Middle Eastern LPs are doing, right? There is a national strategy that some of these sovereigns have to either build out a certain subsector or to build out a certain, perhaps like the VC ecosystem. And they do have capital, and they are willing to invest. And I think what's interesting and what is different between the Asian sovereigns and the Middle Easterns is for some of these Asian sovereigns, they are even willing to back first time funds, provided you are, perhaps you're from the same country or you have some affiliation to that country. They are very willing to take that level of risk, which you don't really see with the other LP groups. Um, so that in turn, I think it's been good for the market in the sense that you have a lot more activity, right? You have GPs who are willing to come out and say, okay, I'll set up a strategic fund for this, or I'm happy to set up a tailor-made mandate for this, which then in turn drives kind of people, founders willing to start businesses, or businesses elsewhere. They're saying, okay, now I'm happy to come to your country and set up a factory or set up an office, and as part of my Asian expansion. So it does attract both kind of business or corporate activity as well as financial activity. Now that said, it's still relatively early days, right? So we're still seeing them in like a deployment phase. What the fruits of this project's gonna turn up as, I think, remains to be seen. But the good thing is it does it does generate a certain level of buzz in the local economy, and I think part of that is also driven, coming back to the NT or deglobalization. Part of these strategic moves are also to just determine some level of security for each of their own respective countries.
Great. And Yingwen, maybe bring us into the due diligence team that you're overseeing and leading as you're underwriting some of these managers. What impact, if you have a GP that walks in and they are working with one of these sovereign funds, does that have an impact on kind of how you view them and might underwrite them differently than maybe a more traditional GP? What is kind of that decision making process from a due diligence perspective and the impact of that?
Yeah. Yeah, well, I'd say it doesn't. Who the LPs are kind of, it's nice to know. But in our diligence process, it rarely does it really sway like, oh, because ABC's invested, therefore you know you're definitely going to be a good fund, right? I think it doesn't really work that way for someone like Auburn, where we're representing over 300 LPs globally. Every LP has a slightly different angle for why they're investing in a fund. So what's good to LP A may not be that good to LP B, just depending on strategy, the makeup of the LP base. I mean, the reality is having a very strong LP could be a double-edged sword, in the sense that you know, for example, when you have to make a difficult LPAC decision, the LPs will vote in the best interest of their own program, and not LP programs are necessarily aligned the same way. So we
Mhm.
have seen situations where some group of LPs got really annoyed because the few largest LPs basically dominated a certain vote, and that was actually at the disinterest of the minority LPs, right? So it happens, right? So in that sense, we do diligence we do kind of ask questions around LP base, LP concentration, but I wouldn't say just because A is in there, it's kind of a gold check. Um, but it really comes down to, okay, what's the dynamics? What are they going after? What's the motivation? And how does that impact uh, my various clients that could be going into the same fund?
Yeah. I want to stay in the seat of Allborn on your team and kind of the internal side, but maybe pivot a little bit in terms of the questioning here, which is now more on kind of your team and staff and
Mm,
the investment professional that you might hire 5 years from now, 10 years from now. One of the things that we heard a lot around these roundtables is with AI becoming more prevalent in the tech stack, with just the way that markets are shifting so quickly. Whether it's regime change or it's a new cycle to our earlier point, the idea that, the investment professional of the future needs to be kind of job ready or have the technical skills, is important, but maybe less important than your ability to think in systems, to be flexible, to have more judgment, cross disciplinary training, and so on. So, this idea that in the future, as things are automated away or augmented, that you need professionals that have a very different skill set than they
Mm.
might have needed today or even a couple of years ago. How do you kind of think about that within your own team and how you hire future professionals? And maybe a more pointed question is, how has AI kind of changed that thought process?
Yeah, no, absolutely. I think one of the beauties of working in a alternative specialist firm is by default you are going to be faced with new products, new strategies, relatively frequently. So by for the analysts, right, that are at Allborn, you kind of learn that it's not a fixed asset class, or even within a fixed asset class, the way a manager could play a strategy could be very different. Like the managers could be really creative, right? When it comes to, it could be structuring, it could be the way they invest, it could be the way they hedge. There are all sorts of new strategies and structures that come up that we have to learn, even at my level, right? It's like, oh wow, okay, I've never seen this before. I've got to kind of figure out how this works. Where's the risk, right? Because when the manager presents it, it always sounds so risk free. And then I'm like, okay, what could go wrong, and where could it go wrong, and what's the damage if it goes wrong? So I think for our firm, just by kind of natural selection, because of the asset class that we're working with, I think this adaptability and ability to just learn new things has always been a core kind of, I guess, tenet that we're looking for. And in this new world of AI, where there are all these new tools and disruptions, this feature becomes even more important, or more prominent, right, in terms of how you do your work. When it comes to AI, I would say I know we at some of these roundtables, a lot of people talk about, I don't have to hire junior analysts anymore, right? I could just jump straight into experienced hire. I think the truth is the AI agents, at least today, right? Their output is only as good as kind of how you input or how you question, and how you come up with the questions is still very much driven by the individual. I know there are some folks who have tried to experiment with reverse prompting, like they kind of give the LLM, say, okay, I want an answer to this question that makes me sound intelligent or experienced, da 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 da. How should I ask it? Like there've been people who tried that, but it's still not exactly ideal. So I think ultimately you still need to find analysts or train them enough that they have a very very firm grasp of the basics, and then they build from there. So what I do like you pointed out earlier, is cross discipline. I think analysts that come with varied or diverse backgrounds, those are interesting because they look at problems in different angles, right? Because if all of us came from the same school and with exactly the same training, we're going to tackle the same problem with more or less the same side of the equation. But having someone that came from something drastically different, they could bring a fresh perspective. So that's something that we do look at when we're hiring analysts. Um, I think judgment is something that it's time. It's going to be chicken and egg. You kind of have to see. I can still remember when I looked at my first fund, I was like, oh, this sounds amazing, like best strategy ever, best fund manager ever. And then by the time you meet your 10th fund, you're like, oh, okay, right? Like everyone, like they all sound kind of, everyone sounds great, right? Then how do you determine like what's the difference, right? And especially I think in Asia, all too often we get asked like, oh, I'm looking at Pan Asia Manager B. How do they compare to Pan Asia Manager, you know, C? Aren't they the same, right? And the reality is actually no. but you really have to look under the hood, because on paper, on labels, they do look, they could look very similar. But once you really dive deep, then that's when you notice a difference. So I think the one quality that we do look for is that level of intellectual curiosity. Um, you cannot just be satisfied because someone handed you an answer. There is a lot of kind of trust but verify, um, and then try to kind of dig deeper.
Yeah. Yeah. I want to maybe end here with the maybe a double down on the systems side of things too. Like, private credit, private equity, alternatives generally, 20, 25 years ago were so small relative to the public markets and the ecosystem. And so you could kind of think of them in isolation in a way relative to other strategies. But today, it's still not the majority of the assets under management, but
Yeah.
there is a true kind of connection between what's happening in private credit and public credit and the banking system, or private equity, public equity, and the economy. Like there's all these ties together. Climate plays an important
Mm,
role for this as well. So I would imagine that the analyst that's doing due diligence is not only having to think through the strategy in isolation, and to your point, this is the coolest thing ever. But then if you take a step back and say, okay, well, if something goes wrong over here, that's kind of
mm,
exogenous to the strategy. How does that impact here, or vice versa?
mm,
If they invest in this data center or this real estate property, what is the impact on climate, and could
mm,
regulation come in? So maybe a long-winded way of asking a question of how do you kind of think about the systems lens
mm.
to investing from a due diligence perspective?
Well, not sure what color the system, but I mean, I think you hit a nail on the head, right? Like right now, the biggest headline that we're seeing in terms of risk is all these software companies that have been fueled by private credit, and or BDCs that are now facing redemption pressures. We have teams of analysts basically running, kind of going through all the data that we have in terms of which companies are being backed by who, how much leverage was in there, what do the fundamentals look like, what does the interest coverage ratio look like, um, and that is something that we didn't previously. We didn't really, if you look at BDCs, it was kind of separate asset class, or private credit, right? It was kind of like a standalone asset class. You didn't really think about what does that mean for the PE fund manager portfolios. But today, because the capital is interlinked, we can't kind of look at them in silo. And I think again, one of the beauties of for the Auburn team is that there's a lot of communication, and we sit in kind of regional pods, right? So you could easily just walk over to the person that's covering the other asset class, but the overlap in say a certain company, and it's like what's going on, right? Like we need to think through this. What does this? How does this impact your fund? What's your GP telling you? And then from my perspective, it'll be like, well, I think my GP is freaking out. Why is your GP not freaking out, right? Over the same
Mm,
asset. So I think that this, probably less about system, but I think cross function or cross team collaboration and communication is very important. Whereas, I think all too common when you see traditionally, like people sit in silos, and then my silo doesn't talk to your silo. um, I think in this new world, especially in the world of private equity, where a lot of private credit has come in to fuel the private equity, the democratization of private funds, be it PE or private credit, means that a lot of these, a lot of the capital now is potentially overlapping. So you can't just sit and think in your own silo.
yeah, yeah. Well, Yingwen, this has been a great discussion. I won't take up any more of your time, but I really appreciate your thoughts and participating in these roundtables, and of course, your commitment to Kaya and what we do, in the local Greater China chapter. So please, keep up the good work, and hopefully, people will find you after this conversation. It's been really informative for me.
Oh, no, thank you for having me.